5 reasons why people choose swing trading. Hello lovely YouTube family, welcome back to our channel. In today's video, we are going to talk about the 5 major reasons why people choose swing trading. Before we do, let's look at some of the investment basics. What you need to know. Are you a first-time investor or new to the market? At the end of the video, you will have learned a lot. Ever since the investment concept came up, more people are joining the investment wagon. Even though the growth rate has steadily slowed down because of the worldwide pandemic, there's hope of things going back to the way they were. Another thing to note is that trading is not easy. It requires time and patience to fully master it. The best part though is that anyone can learn it, no matter what they do for a living. Diversified portfolios are better for long-term holding for stock investors, especially beginners. Active trading, on the other hand, is the way to go if you want a more dynamic and greater fund yield. This entails buying and selling equities based on short-term market changes. Purchase low and sell high. When it comes to trading, this is the fundamental concept. There are several types of trading that you need to be aware of before investing, apart from swing trading. We also have scalping, trading, day trading, and position trading. Scalping. Out of the 4 types of trading, scalping is the most short-term, as with this trading method, traders target minor changes within the day market. Changes by holding their positions for just a few seconds, at most a minute. Day trading. Day trading is also a short-term mode of trading, but unlike scalping, traders keep their positions open for extended periods, often up to a few hours, before exiting when the market shuts. This necessitates the trader and the concerned to make a deeper examination of the market's everyday performance. Day trading also depends on modest revenues that compound up over time depending on the number of people that enter and exit throughout a particular day. Position trading. In this type of trading, traders rely on long-term market fluctuations to get the best gains. The exchange might last a long time, from weeks to months and even years. The emphasis is on major shifts in the market patterns as opposed to modest price swings and moderate pauses or price falls. Swing trading. Swing trading, simply put, is the neutral type, or should I say medium? Swing is trading that can be done for a short or medium period. Swing positions are pretty much a few days or even weeks. Analysis of the market can be carried out over a longer period, lessening the strain of having to monitor it as carefully as those trading through scalping or day traders. Why do people choose it? With the different types of trading, an individual gets to choose what works for them. What may work for one person may not work for the next person. Swing trading is mostly preferred by professionals, especially those that work a 9-to-5 job. They will have time to chase stocks with the other forms of trading while at work. Just like everything else, understanding the pros and cons before involving yourself in anything is very important. Here are some of the other reasons why most people prefer swing trading. Number 5 is time management. The aspect is very crucial when it comes to trading. When a person has regular employment, their trading activity will definitely be limited. It's impossible to conduct trade on your work computer or when you're online. Even if you're able to trade, you'll miss the most important bit of following or having a difficulty in undertaking a complete examination of what is happening in the market at the time. With swing trading, users are allowed ample time to study the market patterns without the pressure of having to respond rapidly. Because the emphasis is on medium to long-term returns, the need to monitor stock performance once the positions are established is not required. As a result, trading can be done while working on a regular job. Number 4, highly profitable. Swing traders are bound to make more money since they focus on making large profits over a longer duration of time. Did you know that swing traders make an average of 5 to 10% profits just in the trading window? On the other hand, the profit is built up for days or even years. And what determines how much profit you'll make? Your profits from swing trading will be determined by 3 major things: how you enter, how you buy, and how you'll sell the stocks. Everything needs to be at the right time. That's why in the beginning we talked about trading skills and how it takes practice to understand. Number 3, the learning curve is more relaxed. Technical knowledge is the most important tool when it comes to trading, and there's no way a person would go into battle without being equipped with the right armor. Trying to trade without enough knowledge is the same. However, the best thing with swing trading is that if you don't have all the information right away, your investment will still be safe, especially if the stocks will be affected by short-term changes. A broad understanding of stock performance might be a useful starting point for entering the market as a swing trader because the focus is on stock performance over an extended period. A working professional will be too busy juggling work and other parts of his life, so they may not really have all the time or enough time to acquire all of the information at once. This is the best trading option for them since it gives them more than enough time to focus on technical details and market analysis. If you're still not convinced, the best part is coming. Stay tuned to find out why we will definitely cross you over to this other side. If the next reason won't still convince you, number 5 definitely will. Number 4, risks are manageable. Traders who are more of investors face a variety of hazards depending on the method of trading they do. One thing is for sure though, it's not possible to categorize the 4 types of trading from lowest to highest in terms of risk. This is because the outcome is still greatly dependent on the trader's actions. Why we believe swing trading risks are manageable is because of how slow the pace is. Because of this, there's a better likelihood of recouping losses because there's less need to sell right away, giving you more time to recoup your losses. Number 5, low capital requirement. For day traders, more capital is demanded since they must maintain buying throughout the day in order to achieve tiny but frequent gains. For these types of traders, the legal beginning amount is about $20,000. And that's the best part to start if you want to make a lot of money. Swing traders can start with the same amount if they choose, but there are no regulatory minimums in place. As a result, it appeals to people who are not willing to exchange large quantities of money. It enables young professionals to enter the market more quickly without being hampered by a lack of funds. Convinced now? Pretty sure you have. If you thought you needed tons of cash, clearly you don't. Do your market research and you're on your way, no matter how little you have. Factors to determine how much you make. The main aim of trading is to maximize profits, and there are factors if aligned well that will determine how much money you can make. These are the strategy, the opportunity, and of course the size of the position. Trading strategy. This is quite simple. An excellent strategy is more likely to make you more money than a bad one would. Sometimes people who wish to start trading believe they have the proper knowledge, and most times, sadly, they don't. To be certain that you have anything that works, you must begin by testing it against past information. Opportunity. The opportunity of how often your approach produces a buy signal is the second key factor to consider. The quantity of signals you receive is determined not only by strategy, but also by the number of marketplaces you trade that strategy on. Position size. This simply means that the more you put on the table, the more you gain or the more you lose. The number of your transactions, on the other hand, should be defined by how much you can risk rather than how much you want to make. Trading should be undertaken over a lengthy period of time, and as a result, you need to protect your capital. This will enable you a chance to trade against even your male losses. The best way to go about it is to try and not risk more than 2% of your account balance on a single deal. This will guarantee you an opportunity to keep trading even if you keep losing daily. With that, nothing should stop you from trading, not even your day job. It can easily fit into everyday schedules, generate large enough profits, provide time for further research, better risk management, and require less capital. All these factors combine to make it the most effective trading strategy for working professionals. And that is all for today, folks. I hope you liked the video. If you did, make sure to hit that like button and subscribe to the channel so that you never miss any amazing videos from us. And as always, let us know your thoughts in the comments section. See you on the next video.